So when I hear people say, well, this is the rich man Roth, it is not. Okay. That is a tale that has been manipulated to sell you a life insurance policy.
Hey, Mike, I have a life insurance policy, but don't feel I need the death benefit anymore. What should I do?
Yeah, let me talk about life insurance generally first,
Okay.
and then let's dive into this question. So first and foremost, what's the purpose of life insurance? It's to pay for a death benefit in case you die.
Yeah. Makes sense, right? You're sort of trading this like, well, I'm going to give them my premium and then.
Now, David, you're a father.
I am.
Your wife is a dentist.
She is.
You both have income.
We do.
How detrimental would it be if one of you just died?
Yeah. I mean, we depend on each other. That combined income stream is crucial.
It's nice.
Yeah.
Yeah. So would you consider term life insurance just to bridge that gap?
Yeah.
What's your expectation to get your money back if neither of you die with term life insurance?
Well, I mean, yeah, we had to go into it knowing that, okay, we're going to pay this just in case, but if no one dies, then A, we're happy that no one died.
Yeah.
But B, we have to also be okay with, well, we just gave them all our money for decades.
Yeah. But and I'm being a little facetious here. People listening are probably going, well, duh, Mike.
Yeah.
Well, hold on. Okay. That is what life insurance is. You are paying a fee to an insurance company for the death benefit so that in case someone dies, you receive a large sum of money in that moment to offset the lost income or lost cash opportunity for whatever that may be for your situation. That is the purpose of life insurance. It is not an investment. Okay.
Yeah.
Now, with that understanding, as you approach retirement, there's a couple of different questions. First off, you have to ask yourself, if you have term life insurance and you're entering retirement, do you want to keep that term policy or not? There's no cash value associated with it. It's term.
Yeah.
That's it, right? So do you keep that term knowing you're paying a higher premium or not? Do you delay your Social Security knowing that the term, if you were to die sooner, that, oh, well, the term life insurance, if I died sooner, that death benefit would offset the potential loss of revenue from Social Security. Like you could play that game if you really wanted to. Okay. And I've seen that happen to certain people that just wanted to transfer that risk to an insurance company, but they knew that the odds were not in their favor, that they were healthy and they probably wouldn't die. Okay. And that's how you got to think about this is whenever you're dealing with an insurance company, the odds are not in your favor. That's how insurance works.
We just have to accept that and be okay with it and understand that's there's nothing wrong with that, right?
Nothing wrong with that.
Yeah.
I mean, that's like getting upset with Coca-Cola because they make a beverage that may not be considered healthy. I don't think Coca-Cola has ever come out and said, hey, this is a healthy beverage. No, they say it is a refreshing beverage.
Yeah.
And it lives up to the claim.
Yeah.
I like Coca-Cola more than Pepsi.
Yeah.
That's a famous dispute.
Yes.
But the point is, let's not assume that something is what it is not. Life insurance is not an investment. Now, it gets a little bit more tricky when you move into permanent life insurance. What's permanent life insurance? This is universal life or whole life. Now, there's different categories within those types of life insurance. You've got, on the universal life side, you've got things like indexed universal life. So it has growth on the upside, but no downside risk, just in fees. So if the markets go down, you don't lose value, but you do pay fees. There's universal life, where it's kind of like this, not exactly fixed, but roughly just kind of steady eddy. It grows at an arbitrary rate. And then you've got variable universal life, where you've got more upside potential, but you've got downside risk as well. Okay, so you've got three different ways you can slice that one up. And then whole life, similar in that situation as well. They're just structured differently. As I am going to define it, knowing all policies are structured a little bit differently, universal life, as I've seen it, tends to front load the fees so that after 10 years or so, then it's a little bit lower, typically in fees for the long haul. Whole life, kind of, as I've seen it, spreads these fees out for the rest of your life. So they're just structured a little bit differently. Is one better than the other? Who's to say? Depends on what you want. But when retirees will get to retirement, okay, they're now second guessing, should they keep buying into the policy? Should they not buy the policy? Should they cut the policy? And that's a very loaded question. So just so we're clear, to the person that asked the question and to everyone listening in, I am not going to tell you to cancel your life insurance policy. This show is not giving individual financial advice. Okay? This is a discussion, and I'm going to point out a couple of things to consider. That fair?
Sounds fair. Yep.
Okay. The first one is understand what you're paying for. Are you paying for riders and additional benefits with the policy? Those additional riders and benefits would cost you money. Do you still want them or do you not want them? Only you can really decide that. Understand the fees associated with it and know that the older you get, there may be an increase in those fees. There may not be, there may be. Just got to look at the details. And you can call the insurance company. They'll answer these questions. They don't hide things from you. They're just complicated policies.
Yeah.
The next one is how large is the death benefit compared to the cash value associated with the policy? So generally speaking, with a permanent life insurance policy, you would fund it until you don't need to fund it, and the cash value and the growth associated with it should maintain the policy until a certain point.
Okay, so the growth of the policy, the company can pull out of the growth to pay the fees.
Yeah.
Okay. Yeah.
Yeah. Now let's be a little bit, I don't know, sarcastic with this just for a moment. I want to prove a point. Okay.
Okay.
Let's say your policy has $50,000 in cash value, and the death benefit is $100,000.
All right.
So the death benefit's like $50K. Do you think that's going to cost a lot of money? Like, no. That's not a lot of money out for the insurance company. So the cost of insurance is going to be very minimal. And that policy you should be able to structure to where you stop paying into it, and it should sustain itself. And as the cash value grows, the death benefit might grow with it because there has to be a corridor or a difference between the death benefit and the cash value. So you might say, look, you don't need it, but there's enough cash value. The fees associated with it are small enough. Just let it ride. And that's a very common situation that I see is stop paying into it, but we just do a re-illustration, we restructure it, and then just let it be. You've already paid into the policy. You might as well just let it grow tax-free. Maybe you borrow against it tax-free. Maybe it's just there for the beneficiaries whenever you pass. That's okay. Now, let's say you've got that $50,000 cash and there's like a $500,000 death benefit. Okay. A $450,000 death benefit. Do you think the fees associated with that are greater?
I would guess so, yeah.
Yeah, of course they are.
Yeah.
Because there's more risk to the insurance company, and so you've got to pay to compensate for that risk. So you've got to ask yourself a question. Are you willing to maintain payments to keep this policy alive so that you have that $450,000 or so death benefit in case you were to pass? These are kind of the questions you've got to ask yourself and go back and forth on. Is it right for you or is it not right for you?
Yes. And so who are these policies for? Like all people listening out there, like permanent life, whole life, like who's that really for? Is it for a certain high net worth person? Is it for the...
Yeah. So I've seen people use policies like, well, so let's do whole life.
Okay.
Whole life's the old school one. I don't see them written as much. It's the old traditional one. It's steady Eddie. It grows. Ideally, you put enough into it at some point you can stop paying into it. But it's just kind of the most boring of them all. Boring isn't bad. Boring means predictable. Okay, no problem with that. The newer policies I've seen typically fall under the universal life umbrella, which is a newer type of life insurance as I've understood it. Just on the new products that are available, the new innovations they've done, they seem to be focusing more on universal life. And that's where I see like hybrid plans where it's like, hey, there's a long-term care benefit that if you qualify, you could tap into your death benefit because if you need long-term care, you're kind of on your way out. That's the harsh reality. So they're going to pay a death benefit anyway. They kind of just make it a little bit easier for you to do that. Now, that might lead to higher fees. You know, there's always a catch to these things. But I've seen people say, well, I can't afford long-term care, but maybe I'll do universal life and kind of do these hybrid plans. So that's for someone that's typically a little bit, I don't know, these aren't cut and dry numbers, but maybe 2 million or less might consider something like that if that's what they wanted. The $1 million or more, I've seen people use universal life for tax planning, but let's be very, very clear. Life insurance is not an investment. You don't buy it unless you want the death benefit, and it's probably not going to outpace the stock market. over the long-term period of time. So when I hear people say, well, this is the rich man Roth, it is not. Okay. That is a tale that has been manipulated to sell you a life insurance policy. People might say, well, this is how you pay estate taxes. Well, when are you expected to die? In your 80s. When did you take out the policy? In your 60s. If you compare the premiums you put in to your life insurance policy and compare that to, let's say, a 7%, 8% average growth, you just put it in the stock market as a difference. By the time you got to your expected death date of mid-80s, you would have had a greater death benefit just by putting it in the stock market and then using that to pay your estate tax or other things. It's only going to be beneficial if it's earlier on. And I get so much resistance from people when I just point this out. And they say, no, well, they said this, or it's even like the insurance agents. When I do training, I'm a national coach. So I train financial advisors all over the country. I'm on the panels, just kind of share the contradictory opinion of things. I just say, guys, you know how to use Excel, right? Just do the math.
Right.
Just question if the thing you're being told is true or not. And it really upsets them when they realize, oh, maybe it isn't as cracked up as I was told. But these are things you need to understand about life insurance. So the rule of thumb is that I've noticed, this is my anecdotal kind of result, is people that have life insurance as they enter into retirement, usually they keep it, but we restructure the policy to lower the cost of insurance. They've already paid into it, and we use it as best as we can. That's kind of what I typically see. I have seen people where there's a higher death benefit, there's lower cash value, and they're like, it's like they're saying whatever, and they just get rid of it because they don't need a death benefit because they've already saved enough. They've amassed enough wealth. They don't need the death benefit anymore. So why would they keep taking out of their cash flow when they could be doing other things with the money?
Right.
But it is such an individualized conversation. You've really got to run the numbers. You've got to look at it from not just the cash value and the death benefit, but the other parts of your financial needs, your healthcare planning, the death benefits, the legacy planning, your estate planning, the tax implications, and so on. Understand what you're saying yes or no to. Many times, the solution you would not have even thought of because you didn't know the right questions to ask. That's why you come in and see someone like us here at Kedrick Wealth, is to not go to the person that's already sold you the policy, the person that's already made the commission. It's kind of like they may not want to spend the time diving in the details. It's already been done. You want to work with someone that, frankly, you're paying them by the hour to give you the objective opinion that's honest, that's forthright, and is very black and white, explaining the benefits and detriments of the various paths that you would proceed. That is key. Hey, thanks for watching this video. Make sure that you like and subscribe first, and then go to www.retireontime.com to grab a copy of my book, How to Retire on Time, take a few courses about retirement, join my newsletter, and so much more. Now, if you want to work with one of our advisors here at Kedrick Wealth, who can help you put together a retirement plan that's designed to last longer than you, just click the button, Get Started. Everything we do is intended to help you retire on time. We hope you enjoy, and we'll see you in the next show.